Welcome back to This Week in Finance, your go-to source for cutting through the noise and getting straight to what matters most in the markets. I'm glad you are here for our week ending April 17th, 2026 recap. Whether you are a seasoned investor or just starting to pay closer attention to your financial future, this channel exists for one clear purpose. We take the biggest stories from the most respected financial outlets across the industry and bring them together into one clean, unbiased weekly breakdown. No agenda, no fluff, just the information you need to stay informed and spot emerging trends before they become obvious to everyone else. Each week we do the heavy lifting so you can walk away with real clarity on where the markets stand and where they might be heading. So settle in because this week was packed with major developments across every major sector worth watching. Before we begin, please note that everything in this video is strictly for educational purposes only and does not constitute financial advice. Investing involves real risk, including the potential loss of your principal. Always do your own research and consult a licensed financial professional before making any investment decisions. Now let's get into this week's market recap. Now that we've covered the ground rules, let me walk you through exactly what we're breaking down today, because there is a lot to unpack from this past week. Over the next 13 plus minutes, we're going to move through this week's biggest market stories in a structured sector-by-sector format. You can follow along using the chapter timeline appearing on your screen right now. We'll start with energy, where oil prices made a significant move that caught a lot of investors off guard. From there, we'll move into financials, then technology and growth stocks where the rebound was hard to ignore. We'll also cover defensive sectors, give you a dedicated gold update, and close out with the latest on Bitcoin and Ethereum, including what the recent ETF inflows are signaling. By the end, you'll have clear, grounded guidance for positioning yourself heading into the week ahead. Let's get into it. Now let's dive into our first major story of the week, and it's a big one coming straight out of the energy sector. Oil prices took a sharp and notable drop this week, and the catalyst was a ceasefire announcement involving Iran. If you watched that animated tracker on your screen just now, you saw that decline play out in real-time style, and it was significant. So why did this happen? When geopolitical tension eases in the Middle East, one of the world's most critical oil-producing regions, markets quickly reassess supply-side risk. Traders who had priced in potential disruptions began unwinding those positions almost immediately. The result was a meaningful pullback in crude prices. And here's why that matters beyond just the energy sector. Lower oil prices act as a natural pressure valve for inflation. When energy costs fall, transportation, manufacturing, and consumer goods pricing can all follow, giving the broader economy some much-needed breathing room heading into the weeks ahead. Now let's zoom into the specific names feeling this pressure most directly. ExxonMobil and Chevron, two of the most widely held energy stocks, are both worth watching closely this week. As you can see on screen, the chart comparison of XOM and CVX tells an interesting story. Both names have pulled back in response to the oil price decline, and that makes sense given how closely their revenue is tied to crude prices. When oil was elevated due to geopolitical tension, these companies enjoyed strong margin tailwinds. But with that tension now easing, the near-term upside becomes less clear. This does not mean either company is broken. Both remain fundamentally strong businesses with solid dividends and long-term appeal. However, if you are sitting on meaningful gains in either position, this week's price action may be a signal worth taking seriously. Trimming slightly or at minimum reassessing your near-term expectations could be a prudent move heading into next week. Shifting now to financials and rate-sensitive sectors, and there was a clear tug-of-war playing out this week. Early in the week, ongoing uncertainty around the Federal Reserve's rate hold decision kept sentiment cautious across the board. Markets were pricing in the possibility that rates stay elevated longer than expected, and that narrative weighed heavily on financial names. But then the de-escalation news hit, and we saw a meaningful relief rally lift several key financial stocks. JP Morgan and Bank of America were two names that stood out specifically. Here's why these matter. Both sit right at the intersection of rate sensitivity and broader economic confidence. When rates stay high, net interest margins can benefit, but loan demand and credit quality become real concerns. For investors watching these names, the signals to monitor are the Federal Reserve's next communication, credit default trends, and consumer spending data. Those three indicators will tell you more about where JP Morgan and Bank of America are headed than almost anything else right now. Shifting now to technology and growth stocks, and this was arguably the most dramatic sector story of the week. After weeks of defensive positioning and cautious sentiment, capital came rushing back into high-growth names in a meaningful way. The catalyst, as we have discussed, was the ceasefire news and the broader easing of geopolitical tension that followed. Here's the mechanics of what happened. When fear drives markets, investors pull money out of volatile, high multiple growth stocks and park it in safer, more predictable assets. But when that fear subsides, that same capital rotates right back into growth. That is exactly what we witnessed this week across the technology sector. The animated charts you are seeing on screen right now tell the story clearly. Upward momentum indicators lit up across the board, with multiple high-growth names posting their strongest single-week gains in months. This rotation was swift, decisive, and broad-based across the entire sector. Within the tech rebound, one name stands out above the rest. NVDA, ticker NVDA. If you want to understand how broader tech sentiment is moving, NVIDIA is often your clearest signal. This stock does not just participate in momentum shifts, it amplifies them. The reason comes down to its central role in artificial intelligence infrastructure demand. Every major cloud provider, every enterprise building out AI capability runs through NVIDIA's ecosystem in some meaningful way. When risk appetite returns to the market, capital flows aggressively into names like this one. We saw exactly that dynamic play out this week with a strong and notable rebound. However, a balanced perspective matters here. Momentum names like NVIDIA can reverse just as sharply as they rally if sentiment shifts again. One negative catalyst, one disappointing guidance update, and the move unwinds fast. Watch the key technical levels closely. Monitor upcoming earnings and any forward guidance around data center spending. Stay informed, stay disciplined. Here's a striking data point worth pausing on. Gold has fallen approximately 9% since war tensions began easing, and that number tells you a great deal about where investor sentiment currently stands. Gold is what markets reach for when fear is elevated. It thrives on uncertainty, geopolitical anxiety, and the kind of risk-off environment we were sitting in just weeks ago. But as the ceasefire news spread and tension in the Middle East began cooling, that fear premium evaporated quickly. When risk appetite returns, capital rotates away from safe havens and back toward growth and cyclical assets. Gold does not pay a dividend. It does not generate earnings. Its value is almost entirely sentiment-driven, which means it can move fast in both directions. On your screen right now, you can see the gold price chart with the key dates annotated, showing exactly when the geopolitical developments triggered that visible downward slope. The timing is not coincidental. It is the market speaking clearly. Even as risk appetite returns to the broader market, defensive sectors continue offering meaningful protection for more conservative investors. Utilities, consumer staples, and healthcare remain reliable portfolio anchors during periods of uncertainty, and this week was no exception. Procter & Gamble continues demonstrating the kind of steady earnings consistency that makes it a cornerstone holding during volatile stretches. Duke Energy similarly provides that predictable dividend income investors lean on when markets feel unpredictable. But here's the important question heading into next week. With geopolitical tensions easing and risk-on sentiment returning, do current valuations still justify holding these names at full weight? Procter & Gamble trades at a premium relative to historical averages, and Duke Energy's rate sensitivity adds complexity given ongoing Federal Reserve uncertainty. For conservative investors, these remain solid holds. For those with higher risk tolerance, trimming modest positions to rotate into recovering growth names may be worth considering as the broader risk environment continues improving. Shifting now to cryptocurrency, and this week delivered some notable moves worth paying attention to. Bitcoin and Ethereum both posted meaningful gains, riding the same wave of improved risk appetite that lifted tech and growth stocks earlier this week. As geopolitical tensions eased and investor confidence returned, capital flowed back into digital assets alongside other risk-on plays. What makes this week particularly interesting is the accompanying surge in ETF inflows. Exchange-traded fund inflows into crypto products serve as a reliable signal of institutional participation. When large institutions and asset managers are actively moving money into Bitcoin ETFs, it reflects genuine confidence rather than speculative retail enthusiasm. This matters because institutional money tends to be more deliberate and research-driven. The correlation between broader market sentiment and crypto performance has become increasingly consistent over recent years, and this week reinforced that pattern clearly. Digital assets are no longer operating in isolation from traditional market forces. Now that we have established why crypto is moving, let us talk about how to think about positioning responsibly. If positive sentiment holds through next week, dips in Bitcoin and Ethereum could represent reasonable entry opportunities for those already comfortable with digital assets. The key word there is comfortable. Crypto remains one of the most volatile asset classes available to retail investors, and that has not changed. What has changed is the structural landscape. Spot exchange traded fund products have introduced a layer of institutional participation that simply did not exist before. That matters for how we interpret inflows and sustained buying pressure. So rather than chasing price targets, think about position sizing first. Ask yourself how much of your total portfolio you are genuinely willing to see drop 30 to 40% temporarily without panic selling. Start smaller than you think you need to. Scale in on confirmed dips rather than all at once. That disciplined framework protects you regardless of which direction the market moves next. Stepping back and looking at everything together, this week told a remarkably coherent story. The Iran ceasefire was the catalyst that set everything else in motion. It pulled oil prices lower, eased inflation fears, reduced geopolitical risk premiums, and unlocked risk appetite across the board. Banking earnings then added a layer of fundamental confirmation, signaling that the financial system remains on solid footing despite ongoing rate uncertainty. When you map these forces together, a clear picture emerges. Energy faces near-term headwinds. Technology and growth names are reclaiming momentum. Gold and defensives are giving back some of their fear premium. Crypto is riding the risk-on wave with institutional backing through ETF inflows providing additional confidence. For portfolio positioning heading into the week of April 20, 2026, the risk-reward balance has shifted meaningfully toward growth and cyclicals. That does not mean abandoning caution entirely, but it does suggest that holding excessive defensive exposure may now carry its own opportunity cost worth reassessing carefully. This week delivered a powerful confluence of market-moving events that reshaped positioning across nearly every major sector. Energy repriced sharply lower as geopolitical tensions eased following the ceasefire announcement, making Exxon and Chevron worth reassessing near-term. Technology and growth names staged a strong risk-on rebound, with NVDA leading the charge higher as fear retreated from the market. Gold pulled back roughly 9%, confirming that safe haven demand is cooling as investor confidence returns. Crypto gained meaningfully, supported by ETF inflows and improving sentiment across risk assets broadly. Financials remain in a holding pattern, with rate uncertainty still creating noise around names like JP Morgan and Bank of America. For the week ahead, consider trimming energy exposure, holding or adding selectively to quality tech, watching crypto on any dips, and keeping defensive positions as a measured hedge. Every move this week traced back to one central shift: reduced fear, renewed confidence, and capital rotating accordingly. Stay sharp and stay informed. Here's the bottom line for this week. When geopolitical fear fades, capital moves fast, and the investors who understand where it flows next are the ones who stay ahead of the curve. That is exactly why staying informed every single week is not optional. It is essential. If this recap helped you see the market more clearly, do us a favor and hit that like button right now. Subscribe to This Week in Finance and turn on notifications so you never miss our Wednesday midweek pulse, our Friday short, or next Saturday's full weekly recap. We want to hear from you. Drop a comment below and tell us what sector or stock you are watching heading into the week of April 20, 2026. Are you watching energy, tech, crypto, or something else entirely? Oh, the end screen is up now. Thank you for watching. Stay informed and invest smarter. We will see you Wednesday.